Okay, good morning, everybody. My name's Chris Sibley, and this is Gillian Roach, and we're going to take you through the national and international accounts for Q1 2025. There's some large numbers in here today, particularly GDP, and we're going to get right down to that to explain where the large GDP growth has come from, and then move on to look at some of the domestic indicators that you'll all be interested in. The GDP number for the quarter is 9.7%, so even for Ireland, that's a large number. And this has come directly out of cross-border pharmaceutical exports in March, particularly March, January, February, particularly March 2025. And we saw that as well in the industry data published monthly as well, that this large increase in turnover and production in industry. So in our infographic, that's the GDP result on the left-hand side there, 9.7%. And just to point out to you, it's the industry, the output method up the top, the industry result on the left of 17.1%. That's where that's coming from. And our other method of measuring GDP along the bottom there, the expenditure method, it's the exports data. There's a little bit of noise with IP in the quarter that's making the investment and imports kind of hard to look at. But if we factor those out, just to take the narrative from me that it's exports on one side and industry on the other, that's driving that GDP number of 9.7%. Leaving those aside, the domestic indicators of the economy, distribution, transport, hotels and restaurants, that's up 1.3%. And some of the domestic data on the other side for expenditure, personal consumption on goods and services, that's up 0.6%. Government expenditures up 0.7%. And if we look behind that investment to, or we like to look at the modified investment data, taking out aircraft and IP, modified investments up 1.5%. So a range of domestic indicators, all in that, just on average, they're just below 1%. For the domestic series, while we have that big GDP result of 9.7%. Just to take you through some of the numbers you may have seen already, this is industrial production and turnover produced by our enterprise statistics, and that's the modern series there that gave you a key to where we were going with those pharma exports. So particularly February and March in this series here around in the production data, just so that really, really large increase in industry. In what we call IPT. You also will have seen this in the cross-border goods exports, and they increased in January and February, but in particularly March there. So that's essentially turnover when the stuff is sold. So both of those monthly series gave us a clue to this. I guess what's new today is we're seeing that M&Es have taken profits from these sales. So you have a big impact on GDP from that, which washes out in GNP, if any of you are looking further down in the data. So if we look at that across time, it does look like the M&E data, we saw it fell in 2023 on the back of a strong 2022, but it's been growing then throughout 24 and into 25. But that number of 9.7 is unusual. That is a big growth rate for GDP now in Q1 2025. The domestic data, you see the small green bar there, that's MDD, modified domestic demand, and we'll explain that and look at some of the series behind that today as well. I'm very conscious that we come to you with three versions of Q1 25 in the space of about 2 months every summer. One is a preliminary estimate. I'll talk about that now. And one is the estimate we have for you today. And then we usually come back in a month's time as well with a long time series. We push all our revisions through. But I guess the stuff today is newsworthy. It's new information, and it's important to explain it to you and give you a chance to ask questions about this. That's the comparison of the early estimate we call the frontier release T30 of 3.2% and a very different number today of 9.7%. What's different? Well, at 30 days we have most of our output method, but it's largely, if you think about it, we had kind of January and February data for the quarter and our output method. At 60 days, we obviously had March. We saw those exports in March, and we get full sets of company accounts for our large cases units. So we've inspected all of these numbers, talked to all the large cases, and checked out all the data now. So we have much better sources at 60 days. And another month, we'll have another set of the data, but I think most of the information's through here for you today. Looking at the sectors of the economy, the two M&E sectors, we see that it's steady growth in ICT. Right? So the tech sector, that over 3% growth is steady growth in the tech sector. It's really about industry, or in particular pharmaceuticals today, and that surge in pharma exports in Q1 25. And we weigh up all the sectors in the economy, look at all the foreign sectors and all the domestic sectors, we see that the growth is off from the foreign sectors. If we were to dwell a little bit on the domestic sectors, that small green bar there, and see what's going on in the domestic economy, we'll see that steady rise in the public sector, public admin, education and health. And we see it on the other side of the accounts too. We see it in the wage bill, steady increase in government expenditure. The construction sector might get some attention this quarter, but it is kind of cyclical. We're seeing those ups and downs. A large increase this quarter in construction, but a fall the previous quarter. And the biggest domestic sector by far is this distribution, transport, hotels and restaurants in blue there, with an increase in the quarter. Pulling some wage data just to show you what's going on there, linking our national accounts back to the labour market, I guess. The left-hand side, seasonally adjusted constant price wages are up 0.9%, so right in line with all the other domestic measures. The chart on the right is in current prices, so it's not the same thing, but we can give you different detail, different breakdown when we look at the data in current prices. And there we can see the lines are the wage bill, the amount of money spent on wages for the domestic and foreign sector. The foreign sector there is a darker, lower line. You see those spikes around Q1. That's usually bonus payments that we see driving the M&E data in Q1. And the higher line is the domestic wage bill. The two bars are numbers of people. And this comes from the frontier release in our labour market area about monthly employment. So that's a lot of the output method and some income details. The other method of measuring GDP is the expenditure method, where we look at everything we spend on goods and service, what the government spends, what we invest, and the traded sector. And the first thing we usually do here is strip out the traded sector and modify investment. So that hatched orange bar is the modified investment data. So we take out IP and aircraft and just look at buildings, vehicles, and those kind of things in the economy. That's modified investments up 1.5%. So a little higher than the other domestic indicators, but we add that 1.5% in with the small increases in wages, small increase in consumption and the small increase in government expenditure, and we get our MDD result, which is the light blue line in the middle there. So MDD is up 0.8%. And over time, when we look at modified domestic demand, we see sometimes, like last quarter, that we had a fall in investment and a rise in consumption. They offset each other, but they're all small increases. So what's driving MDD, our deglobalised measure this quarter? It's small increases in consumption, government and investment. That's the headline, I guess, there with that. Looking at each of those, we see consumption, so what you and I spend on goods and services, that's up 0.6%. If we look at the government sector, I guess the message there on that is since COVID, we saw a large increase in government spending. And over the last 2 years, it's just been a steady, small increase in government spending. And that's contributing to MDD this quarter of 0.7% for government spending. And investment, as I said to you with the infographic at the start, it's a little bit hard to interpret investment this quarter because of IP is affecting it, the orange part of the bar chart there. And we have to strip that out. And when we do strip it out, we can find some variables. We can't talk too much about the modified measures on cap form. Machinery and equipment's up substantially, so you can see the aircraft effect, I guess, there. Intangibles are up by 8.5 billion, so you can see kind of there's an IP effect too. But what can we pull from it? Well, the construction investment data is up 3.4%, and the overall modified investment's up 1.5. So that's the 1.5 you want to put into modified domestic demand. I leave probably exports and imports for Gillian to explain to you. There's a lot going on there, but obviously that feeds into our expenditure method to get us the total. And something to highlight for us that's really important this quarter, some of the news this quarter, there's a really large profit outflow. So net factor flows are 55.5 billion there, taking us from GDP to GNP. So we see everything's produced, gets into GDP. What remains in Ireland is in GNP, so the profit outflow is very large. And again, perhaps Gillian shed some light for you on that one. But that's an important measure in the national accounts today. We had that production, the exports of pharma, but there was profit taking, I guess, from MNEs on the back of it. And that's what gives us today's result. So to summarise the national accounts for Q1, we have that really large GDP growth rate of 9.7%, driven by industry under one method, the output method, and it's exports under the expenditure method on the right-hand side. And if we look at some of the domestic features, if we weigh up the sectors there on the left-hand side, the domestic sectors in aggregate are up 0.7%. And on the right-hand side, for some domestic features, consumption, PCE, is up 0.6%, government expenditure 0.7%, modified investment 1.5%. And we put those all together into our globalised measure, modified domestic demand, and that's up 0.8%. And then we can round it out with, at the bottom of the chart there, wages or compensation of employees up 0.9% too. So we have a big headline number for GDP related to those pharma exports, and the range of domestic measures are coming in just under, on average, just under 1%. I'll hand you over to Gillian now for the international accounts.
Thanks, Chris. So I'll take you through the international accounts for Q1. We'll start off there with our infographic. So we see there that the current account balance at the end of Q1 stands at 6.6 billion, or 4.1% of GDP, and that's made up of merchandise balance, imports and exports of goods, service balance, and the income balance. So merchandise, we have a balance there of 74.2 billion, with high exports of 113 billion and imports of 39 billion. Service exports are 115 billion and imports at 116, giving us a services balance of minus 0.4 billion. And then those income flows, inward income of 74 billion and outward of 142 billion, giving a negative balance of 67.2, all of which combines to give our current account balance of 6.6 billion. And at the end of Q1, the net international investment position stood at minus 431 billion, and foreign direct investment in Ireland at just over 1.2 trillion. So we look at that current account balance over a short time series there as a percentage of GDP. You can see that with the large IP imports, we have a lower balance than in recent quarters for Q1 2025. And then if we look at the decomposition of that, we can see that the merchandise balance, reflecting those strong exports, is up in Q1 by 19.8 billion compared to the previous quarter. The services balance is down by 5.2 billion. That's in green. It's on the scale of that graph, it's scarcely visible in Q1. And the net income outflows, which are mostly represented by that yellow bar, have increased by 26.3 billion in the quarter. And so we have then a current account balance, which is represented by the green line there, which is down 11.6 billion compared to Q4 2024. So then, looking at the same period last year, we see that the current account balance has decreased from 14.9 in Q1 24 to 6.6 in Q1 25. So that's a decrease of 8.3 billion year on year, and that's principally driven by the different levels of IP imports in those two periods. And within that, we see that the merchandise surplus balance is up from 38.8 to 74.2. The services balance is down by from 9.3 to minus 0.4, and the net income outflows having increased have almost doubled, or slightly more than doubled there, from 33.2 to 67.2. So we'll talk about those exports in a bit more detail. So you can see there for Q1 that increase in exports, and that's largely being driven, so the navy bar, and that's largely being driven by the cross-border trade in goods, which is the light blue bar there beside it. And we can see also that our Q1 goods imports which are there in orange and yellow respectively, so it's the total imports on a change of ownership basis, and the portion of which is the cross-border trade. And they're both up as well, but they are up to a smaller degree. So the increase then in the net merchandise balance is principally driven by those increased exports. Go back to zoom in a bit on that graph. Chris showed you of the monthly trade figures. We can see that increase through Q1 up to that high level of exports in March. And if we break that down a little further, then, so if we look at by region first, you can see there in Q1 those high level of exports going to the US are what's driving those figures. And just looking at March for a breakdown by product, we see that the growth there is really in the chemicals and related products category, and that's where you see the pharmaceuticals exports. So moving on then to services exports, we have an overall increase of 10.2 billion, and that's predominantly in the computer services area with an increase of 9.7 billion, while business services are down 1.1 billion. Within that, we see an increase in operational leasing exports of 201 million. And tourism, travel and services are both down in the period by 254 and 201 million respectively. For our service imports, we can see compared to Q1 last year, we've an overall increase of 19.9 billion. And within that, business services have increased by 16.1 billion, and of that, R&D is increasing by 13.5 billion. And this is largely driven by the difference, again, in the level of IP imports between the quarters. There's an overall increase of 2.5 billion there in miscellaneous business services, while royalties have increased by 4.8 billion and tourism services are down 481 million on the same quarter last year. So we see there that the increase in imports is largely driven by those increases in R&D. Then if we take a look at the royalties a bit more closely, so the top line there, the blue line, gives us the overall royalty figures, and then that's broken down into pharmaceuticals and others, pharma there in the green, and the other category is dominated by the ICT sector. So for pharma, we can see from the previous quarter we've got a decrease of 3.2 billion and an increase from Q1 24 of 783 million. And overall, where we're just looking there at the navy line, we see an overall decrease from Q4 24 of 8 billion and an increase from Q1 24 of 4.8 billion. The decrease we can see is in both the pharma and the ICT royalty imports, whereas the overall increase across the year is driven by mainly by ICT royalty imports. And then if we move to direct investment income, we see there the inflows is the dark blue bar in the quarter of 21 billion, and outflows, the green bar, which are those mainly those M&E profits that Chris already mentioned, of 85.1 billion. And that results in net direct investment income outflows for this quarter of 64.1 billion. Looking back to the same quarter last year, inflows are up in this quarter at 3.2, and outflows, again mainly those profits, are up 36.3. Giving us net outflows of 33.1 compared to last year. And looking at the previous quarter, the inflows are down by 3.5 billion, while outflows have increased by 21.5 billion, giving us an increase in net outflows of 25 billion compared to the last quarter. And then just looking at the breakdown of those quarterly profit outflows, we see, as has been said already, that the increase in this quarter is mainly driven by increases in the manufacturing sector. So we've seen an increase there compared to last quarter of 24 billion, with an increase in ICT of 683 million. Compared to quarter one last year, that increase of the manufacturing sector is 33.4 billion, and in ICT it's 4.1 billion. So just lastly then, I want to come to our current account with the US, which we've been presenting for the last few quarters. So we can see here that the merchandise balance is up by 35.7, reflecting those exports that we saw earlier on. It's up by 35.7 year on year compared to Q1 24, reaching a level of 50.6 billion in Q1 25. The services balance has decreased by 17.8 billion, giving us a services deficit of Q1 of 52.6 billion euro, and the net income outflows, which are that yellow bar in the middle, have increased by 6 billion compared with the first quarter of 2024. So that positive merchandise balance then is being offset by negative net services and negative net income, resulting in a current account deficit of 24.8 billion in the first quarter of 2025, which is up from the deficit of 36.6 billion in the previous quarter by 11.8 billion. So just to summarise those headline figures then, the current account balance in Q1 2025 stands at 6.6 billion or 4.1% of GDP, and what's driving that really are those large increases in the merchandise exports in this quarter and the associated increases in income outflows. So I'll hand you back to Chris to summarise.
Thanks, Jerry. So just to finish off GDP, I think again just one more time to finish up. So we've got that really large GDP growth rate of 9.7%, driven by the MME data in the quarter. Then we have a run of domestic measures, consumption of 0.6%, modified investment 1.5%, the domestic sector is 0.7%, and the wage bill 0.9%. So putting all that domestic data together, we get our summary measure of the domestic economy, modified domestic demand, that's at 0.8%. Just before we take some questions, I just mentioned to you, we will be back again in about a couple of weeks, about 30 days' time, to look at another version of Q1, but it'll have a recast time series. Lots of changes to 22, 23, 24, and a recast time series. No big items to flag, there's standard revisions, but we're also going to run a seminar at that stage, like we did last year. So we're going to do a session on the US trade and our economic relationship with the US. We're going to do a session on domestic and foreign productivity, and we're going to talk a little bit about prices. So I think that's just something to keep in your calendars for a month's time. So I'll open it up to questions now in the room and online, whoever wants to go first.